Hey, what's up, everybody? Thursday, April 1st, April Fools. Yo, listen, I bit my tongue today really hard this morning eating a piece of toast. And it hurts like hell. It still hurts. So if I am talking funny, that's the reason why. New high in the S&P. New high in the Dow Jones. Actually, S&P above 4,000 now. I tell you, folks, it's been a remarkable recovery. And again, like I said yesterday, we're living in a real-time laboratory of fiscal policy where you can see the effect of fiscal expansion. Now, one thing we have not been able to see, at least fully, is the full recovery in the economy. And that's because, a lot of it's been shut down and because of the pandemic, and now it's opening back up again. But the stock market is obviously anticipating a boom in corporate earnings. That's what's going on here. And I've been telling you this over and over and over again. It's not rocket science. There isn't an amount of economic weakness that cannot be countered with the proper fiscal response. And it doesn't simply mean, handing out checks. Like, I like what Biden is doing here with national investment, infrastructure, healthcare, taking care of the elderly, this kind of, fiscal policy focused on narrowing some of the income inequality. It's a positive. And that's still yet to happen. So, I think we're in a Goldilocks scenario. The other thing is, you see bond yields starting to slowly come back down again. Now, I think the jury is out on this to the extent that we don't know how powerful the recovery is going to be, but more importantly, because I've always said that growth does not equate to inflation. You need to have something broken in the system to have inflation. Money printing does not equate to inflation. You need to have something broken in the system or some monopolistic force to have inflation. A 1-year price increase, a relative increase versus last year because you had a pandemic, that is not inflation. Inflation is steadily rising, constantly rising prices. Excuse me. Hurts, man. When I talk, it hurts. All right, what else? SLR. Yesterday, the exemption on reserves, the reserve treatment of reserves in the SLR expired. We're going to see what happens. I mean, the Treasury's account at the Fed right now is at $1.1 trillion. They want to bring it down to $500 billion. Actually, it was supposed to happen by the end of March. March is over, but let's just take them at their word. That means another, $600 billion of reserve addition. So we're going to see if all that hysteria, and all that hand wringing, oh my God, what's going to happen because of the SLR? We're going to see if that ends up causing disruption, ends up causing havoc, because that's the way it was portrayed. So in the month of April, I suspect we will see, but then again, in the month of April, I suspect we will see the remainder of the Treasury's balance, at least the remainder up to the point where they want to bring down the balance. That $600 billion spent out. And we'll see the reaction in the markets. We'll see if that crashes the market. I suspect it won't. And the reason I'm saying that is because the banks had ample time to prepare for this. They knew what was going to happen. Sorry. So, I don't think it's going to be a panic. I don't think it's going to be very disruptive, but we'll see. My outlook right now is bullish. Let me mention something about oil, because OPEC, and I did comment and say that sometimes inflation can be caused by a monopolistic force or a cartel. OPEC, really, you're talking about the Saudis as really the monopolists. They said they were going to raise output in May, June, and July. About 1 million barrels a day total. I think it was like 400,000 or 450,000 in May, then 350,000 in June, and then 300,000 or something like that. In the 3 months starting with May. I'm already seeing in Brent crude spreads where there was a steep backwardation meaning that spot futures were trading at a very high premium to deferred. In other words, signaling tightness in the oil market. That peaked out in early March, and we're starting to see a moderation in that spread. In other words, it's narrowing, okay? It's coming back towards a contango. It's not in a contango yet, but it's coming back in that direction. If oil prices moderate here, if they come down, a lot of this inflation impulse will also be reduced. And you're going to see a rally in bond prices and a decline in bond yields. And the Fed may end up to be right. Powell may end up to be right. He said that inflation pressures were going to moderate. And this is one time, as you know, because I've been saying it, that I have to agree with the guy. All right? But folks, I don't know what to tell you. I see a lot of negativity out there, a lot of negativity. People just want this market to crash so bad. They just want it to crash. I don't know what is the root of that. I talked about it once, like when I was a floor trader. I did a whole video on this. Like everyone in that pit, with the exception of a few guys, and they were the biggest traders. Everyone else, we just wanted to short the market all the time. And don't ask me why. We just wanted to short the market all the time. That's all I ever did during my days as a floor trader. Now, I had a lot of fun, but it was, I don't know, you got to do some kind of a psychological study on that. And I see that now. I see that with people. I haven't been on a floor. There's no floor anymore to speak of. Everything's electronic. But I see that now with people. Like this just inherent negativity. Like it's got to crash. And everything's got to go to hell. And I just can't figure it out. All right, no market action tomorrow because it's Good Friday. If you're celebrating, enjoy. If you're celebrating Easter, and enjoy. I'll be making videos tomorrow over the weekend. All right, so take care, everybody. Hopefully, my tongue is gonna feel a lot better. Don't bite your tongue. It hurts. Bye.